All right, buckle up, because what's unfolding right now isn't just a trade war. It's not just tariffs or Twitter tirades. No, this is something far more dangerous. We are witnessing a seismic shift, a financial decoupling between the world's two largest economies, the United States and China. And unlike the flashy headlines screaming about exports and sanctions, the real battle is being fought in the shadows, in the global financial system. Let's talk about what's really happening beneath the surface. 3 months ago, Donald Trump threatened to cut off the flow of American investment into China. In the past, this would have been a death blow. 10 years ago, a move like that could have sent China's financial markets into a tailspin. But this isn't 2014, this is a new era. One where Beijing is playing a longer, more strategic game, and Washington, whether it realizes it or not, is upending the system it built. At the exact moment the United States is escalating a costly trade war, it is also trying to flood the global market with $2.5 trillion in new treasury bonds. This is in 2025, a year where America is looking to borrow more money than at almost any time in its history. But here's the catch. Trump is simultaneously cutting imports and raising tariffs. That may sound patriotic, but it's a wrecking ball to the dollar's global utility. Because here's how it used to work. Countries sold goods to the United States, got paid in dollars, and then recycled those dollars back into US assets, primarily bonds. That's how the system functioned. That's how America sustained its deficits. That loop of trade-feeding capital markets is what kept interest rates low and the dollar king. But Trump, he's smashing that loop to bits. And bond yields are already reacting. The 30-year yield has spiked above 5%, a level that makes borrowing painful for everyone, from the government to homeowners. The demand for US debt is thinning out fast. Meanwhile, back in DC, we're hearing fantasy talk. This bill does not add to the deficit. In fact, it saves $1.6 trillion. But economists from across the board say the bill will add $3 trillion to the deficit. Either they've discovered a magical new math, or Washington is just lying through its teeth. Regardless, investors aren't buying it, literally. They are refusing to hold US debt for long periods. In fact, the average maturity of debt holdings has dropped below 6 years, one of the lowest among major economies. Why? Because bondholders are bracing for either inflation or the collapse of the dollar itself. This is where it gets truly alarming. While Wall Street struggles to keep investors engaged, China is launching its own financial counteroffensive. And it's not subtle. Enter CATL, the battery manufacturing titan. This Chinese company just pulled off the biggest IPO of 2025, raising $4.6 billion on the Hong Kong Stock Exchange. Let me repeat that. A blacklisted company by the US Pentagon raised billions, and investors made a killing. On day one, shares soared 16%. This is more than a stock market win. This is a geopolitical flex. Every dollar that goes into Chinese IPOs is a dollar not going into US Treasury bonds. And remember, capital flows are a zero-sum game. China isn't just attracting money, it's siphoning it away from Wall Street. Beijing is now openly competing with Washington for global investment capital. And it's working. The US economy is heavily financialized. It depends on constant inflows of capital to keep stock prices high, bond yields low, and the dollar strong. When that stops, 3 major things happen. 1, stock markets stall or collapse, wiping out household wealth and crushing consumer confidence. 2, bond yields spike, pushing mortgage rates, car loans, and business financing into dangerous territory. 3, the dollar weakens, making imports more expensive and stoking inflation at home. All 3 of these are already happening, slowly but steadily. And as China's companies surge, so too does its broader economic strategy. Beijing is going global while Washington turns inward. China's IPOs are backed by real industrial might, by companies like CL, which controls a jaw-dropping 38% of the global EV battery market. Tesla, Mercedes, and Ford all depend on this company. Despite Washington's blacklist, the global economy still runs through China. But there's another secret weapon. Money is dirt cheap in Hong Kong. We're talking borrowing rates as low as 0.5%. Compare that to Wall Street, where rates are sky high. Investors looking for yield are now looking east. Meanwhile, Chinese companies enjoy world-class supply chains, booming exports, and rapidly growing foreign sales. From 2018 to today, the share of revenue from overseas for Chinese brands has jumped from 9% to 10.7%. That's not an accident, that's strategy. In America, Wall Street leads the economy. In China, the real economy leads the stock market. It's the opposite model, and it's proving to be far more resilient. And then came the bombshell. Moody's downgraded US debt, stripping it of its last remaining AAA rating. It's official. Microsoft now has a better credit rating than the United States government. Let that sink in. What was once unthinkable has now happened, and the consequences are global. Hong Kong's massive pension funds, some of the largest in Asia, are legally bound to only invest in AA-rated government debt. And with the US losing that status, there's talk of forced selling. $63 billion worth of treasuries could be dumped onto the market. The financial heart of Asia is now sounding the alarm. Who cares? Trump's economic team shrugs. Saudi doesn't, the UAE doesn't. But Hong Kong does, and so will others. Because here's the scary part, this downgrade sets a precedent. If more agencies follow suit, and there are strong signs they might, it could trigger a cascade of selling across Europe, Asia, and even domestic pension funds. Once confidence is lost in the safety of treasuries, it's game over. The exposure is vast. Even if Hong Kong only holds 2.3% of total US debt, the symbolic blow is massive. The world reserve currency issuer has never before lost its top-tier credit standing across the board. This is uncharted territory. And amid all this chaos, Trump continues to contradict himself every time he opens his mouth. So I'm a fiscal hawk, I'm the biggest fiscal hawk, nobody spends like me. Wait, what? Calling Trump a fiscal hawk is like calling a pyromaniac a firefighter. The man has overseen ballooning deficits larger than his predecessors, then turns around and claims to be cleaning up the mess. If this were a sitcom, it would be hilarious, but this is real life, and the global bond market is reacting accordingly. The term premium, the extra return investors demand to hold long-term debt, is climbing fast. Why? Because investors don't believe the United States will ever get its fiscal house in order. In fact, they're expecting more chaos, more debt, and more inflation. Ray Dalio, the billionaire hedge fund manager, recently said the quiet part out loud. The real risk isn't just default, it's debasement. The United States will print money to pay its debt, and that's a form of default. He's right. If you lend the United States government $100,000 today and get repaid in 10 years, but the dollar is worth half as much, did you really get your money back? That's the danger. Not default in the traditional sense, but default through inflation. As more capital flows to Hong Kong, as Chinese IPOs dominate headlines, and as the United States stumbles from one policy blunder to another, the world is slowly moving away from the dollar. It's not a collapse, it's not an explosion, it's more like erosion, a slow, steady crumbling of confidence. The semiconductor war is the perfect analogy. China may be behind today, but the United States keeps scoring own goals. Every downgrade, every contradictory policy, every reckless fiscal bill accelerates the shift. Hong Kong's rise as a financial hub isn't just about Chinese companies. It's a symbol of a broader transformation. The world is diversifying away from Wall Street and toward a multipolar financial order. And here's the kicker, there is no historical precedent for a reserve currency nation losing its credit worthiness like this. No roadmap, no manual, just risk and reaction. So what happens next if global funds continue to reduce exposure to United States treasuries, if China continues to deepen its capital markets, if the dollar loses even a fraction of its global dominance, then we are entering a world where America no longer holds the monopoly on global finance. And in that world, Hong Kong isn't just rising, it's winning. What do you think? Will China overtake Wall Street in the next decade? Will Trump ever take the deficit seriously, or is fiscal discipline just another punchline in this Twilight Zone reality? Let me know in the comments. Be sure to like and subscribe, because in a world this unpredictable, staying informed isn't just smart, it's survival.